Third-party ownership. Which of the following insurance arrangement will be appropriate for a parent buying a life insurance policy on a child where the parent is the policy owner? Answer is B. Third-party ownership. Contracts that are owned by someone other than the insured are known as third-party ownership. Most policies involving third-party ownerships are written in business situations or for minors at which the parents owns the policy. Which of the following insurance arrangement will be appropriate for a parent buying a life insurance policy on a child where the parent is the policy owner? All of the following are general requirements of a qualified plan except the plan must provide an offset for Social Security benefits. Employer contributions made to a qualified plan are subject to vesting requirements. Qualified plans must have a vesting requirements. Which of the following is not true regarding non-qualified retirement plans? C. It needs IRS approval. Non-qualified retirement plans do not meet the IRS requirements for payroll tax treatment of deductions and contributions. Therefore, they do not need to be approved by the IRS. All the following requires qualified except this must meet the general requirements established by the IRS. All the following statements are true regarding tax qualified annuities except C. Employer contributions are not tax deductible. An employer quits her job where she has a balance of $10,000 in her qualified plan. If she decides to do a direct transfer from her plan to a traditional IRA, how much will be the transfer from one plan administrator to another, and what is the tax consequence of a direct transfer? D. 10,000, no tax consequences. Which type of retirement account does not require the owner to start taking distribution at age 72? D. Roth IRA. Roth contribution can continue regardless of the account owner's age, and in contrast with the traditional IRA, distributions do not have to begin at age 72. For a retirement plan to be qualified, it must be designed for benefit of employees. Qualified plans are designed for exclusive benefit of the employees and their beneficiaries, who can make fully deductible contributions to traditional IRA. A. An individual not covered by an employer-sponsored plan who has an earned income. Individuals who are not covered by an employer-sponsored plan may deduct the amount of their IRA contributions regardless of their income level. All of the following except statements concerning an employee-sponsored non-qualified retirement are true except the employer can receive a current tax deduction for any contribution made to the plan. Employers do not receive a current tax deduction for any contribution made to a non-qualified plan. The plans are legal, however, they do not qualify for any favorable tax treatment under the IRS rules. For a retirement plan to be qualified, it must be designed to the benefit of employees. All of the following employees may use the 403(b) plan for their retirement, except the CEO of a private corporation. Not all public employees are eligible for 403(b) plans or tax-sheltered annuities. Only employees of public, educational, local, state, or federal, as well as employees of charitable organizations. A tax-sheltered annuity is a special tax-favored retirement plan available to certain groups of employees only. A tax-sheltered annuity is a special tax-favored retirement plan available only to certain groups of employees, non-profit, charitable, educational, religious, and other 501(c)(3) organizations, including all employees in public education. An IRA purchased by a small employer to cover employees is known as D. Simplified Employee Pension Plan. A simple employee pension is an employer-sponsored IRA. Contributions to the plan are not included in the employee's taxable income for the year, to the extent that they do not exceed the maximums allowed. Distributions from SEP are taxable as ordinary income when received at retirement. Life insurance needs analysis and suitability. An IRA purchased by a small vendor to cover employees is known as a simplified employee pension plan. A producer is helping a married couple determine the financial needs of their children in the event one of both should die prematurely. This is a personal use of the life insurance known as the survivor protection. Life insurance can provide the funds necessary for the survivors of the insured to be able to maintain their lifestyle in the event of the insured's death. This is known as survivor protection. A tax-sheltered annuity is a special tax-favored retirement plan available to certain group of employees only. Who is the owner and who is the beneficiary on a key person life insurance policy? The employer is the owner and the beneficiary. With a key person coverage, the business employer is the applicant, owner, and premium payer and beneficiary. Partners in business enter into a buy-sell agreement to purchase life insurance, which states that should be one of them die prematurely, the other will be financially able to buy the interest of the deceased partner. What type of insurance policy may be used to fund the agreement? D. Any form of life insurance. Any form of life insurance may be used to fund a buy-sell agreement. Partners in a business enters into a buy-sell agreement to purchase life insurance, which states that should one of them die prematurely, if or which of the following statements concerning buy-sell agreement is true? Buy-sell agreements are normally funded with a life insurance policy. A buy-sell agreement is simply a contract that establishes what will be done with a business in the event that an owner dies. Buy-sell agreements are normally funded in the life insurance policy. What is the purpose of a key person insurance? To lessen the risk of financial loss because of the death of a key employee. Business can suffer a financial loss because of a premature death of a key employee that has specialized knowledge, skills, or business contracts. A business plan can lessen the risk of just loss by the use of key person insurance. Which of the following is correct concerning the taxation of premiums in a key person life insurance policy? Premiums are not tax deductible as business expense. The business cannot take a tax deduction for its expense of the premium. However, if the key employee dies, the benefits paid to the business are usually received tax-free. All of the following statements concerning the use of life insurance as an executive bonus are correct, except it is considered a non-qualified employee benefit. No. The answer is B. The policy is owned by the company. The policy is owned by the employee. A corporation is the owner beneficiary of the key person life insurance. If the corporation collects the policy benefit, then B. The benefit is received tax-free. Should a key person die, the benefit is treated as a reimbursement to the business for loss of service from that key person. Partners in a business enter into a buy-sell agreement to purchase life insurance, which states that should one of them die prematurely, the other will be financially able to buy the interest of the deceased partner. What type of insurance policy be used to fund this agreement? Any form of life insurance. An individual has been diagnosed with Alzheimer's disease. He is insured under the life insurance policy with the accelerated benefits rider. Which of the following is true regarding taxation of the accelerated benefits? The portion of the benefit up to a limit is tax-free. The rest is taxable income. When accelerated benefits are paid to chronically ill insured, they are tax-free up to a certain limit. Any amount received in excess of this dollar limit must be included in the insured's gross income. If an insured surrenders his life insurance policy, which statement is true regarding the cash value of the policy? It is only taxable if the cash value exceeds the amount paid for premiums. The cash value of a surrender policy is only considered to be taxable as income if the cash value exceeds the amount of premiums paid for the policy. Which of the following is not true regarding policy loans? A. Money borrowed from the cash value is taxable. Money borrowed from the cash value is not taxable. Policy loans can be repaid at any time, including surrender and debt. An insurer can charge interest on outstanding policy loans. An individual has been diagnosed with Alzheimer's disease. He is insured under a life insurance policy with accelerated benefits rider. Which of the following is true regarding taxation of the accelerated benefits? C. Portion of benefits up to limit is tax free. The rest is taxable income. In which of the following instances would the premiums be tax deductible? D. Premiums paid by the employer on a 30,000 group term life insurance plan for employees. As a general rule, premiums paid for the life insurance are not tax deductible. The exception to this is when the employer buys group term life insurance for his employees since it is considered a business expense. An insured has a modified endowment contract. He wants to withdraw some money in order to pay medical bills. Which of the following is true? You will pay the A. He will have to pay a penalty if he is younger than 59 and a half. Any cash value life insurance policy that develops cash value faster than the 7-pay whole life contract is called modified endowment contract. It loses the benefit of a standard life contract. All withdrawals are subject to taxation on a LIFO basis, last in first out, and if withdrawals are made earlier than age 59 and a half, a 10% penalty is imposed. When beneficiary receives payments consisting both principal and interest portions, which parts are taxable as income? B. Interest only. If a beneficiary receives payments that contain both principal and interest portions, only the interest is taxable as income. The premiums paid to employers in a business life insurance policy are A. Tax deductible by the employer. The premiums that our employer pays for life insurance on an employee whereby the policy is for the employee benefits that are tax deductible to the employee as a business expense. In which of the following instances would the premium be tax deductible? Premiums paid by employee on a 30,000 group term life insurance plans for employees. Fine. Regarding the taxation of modified endowment contracts is false. Withdrawals are not taxable. What is the main purpose of 7-pay test? It determines if the insurance policy is a MAC. Correct. 7-pay test determines whether an insurance policy overfunded or its modified endowment contract. In other words, the cumulative premiums paid during the first 7 years of the policy must not exceed the total amount of net level premiums that would be required to pay the policy up using guaranteed mortality, costs, and interest. In which the following instances would the premium be tax deductible? Premiums paid by employee to group term life insurance plan for employees. Which of the following statement regarding taxation of modified endowment contracts is false? Withdrawals are not taxable. Social Security was created to provide all of the following benefits except employment income. Social Security is designed to provide if a life insurance policy depends cash value faster than a 7 pay whole life insurance, it becomes a D modified endowment contract. Any cash value life insurance policy that develops cash value faster than a 7 pay whole life contract is called modified endowment contract. It loses the benefit of a standard life contract. To attain current insured status under Social Security, a worker must have earned at least how many credits during the last 13 quarters? 6 credits. To be considered currently or partially insured, the individual must have earned 6 credits during the last 13 quarter period. Taxes. Okay, quiz. Question 1 of 15. A 60-year-old participant in the 401k takes distribution and enrolls it over to IRA within 60 days. Which of the following is true? No taxes are due since the plan's participant is over age 59 and a half. There's a 10% early withdrawal penalty. The amount distributed is subject to ordinary income tax. The amount of distribution reduced by the amount of 20%. Distributions from 401k plans are taxable as ordinary income in the year of the distribution. However, if the distributions roll over to a traditional IRA, taxes are deferred until the required minimum IRA distribution begins, which is generally no later than age 70 and a half. Since this client actually took a distribution instead of making trustee to trustee rollover, the distribution is subject to 20% withholding tax. Question 2. An employee quits his job, converts his group policy to an individual policy. The premium for the individual policy will be based on his experience. Attain age. If an employee terminates membership in this insured group, the employee has the right to convert to an individual whole life policy without proving insurability. The insurer will determine what types of policy an employee may convert to, but it must be issued to a standard rate based on the individual's attained age. Which of the following terms is used to name the non-tax return of unused premiums? Dividend. The return of unused premiums is called dividend. Dividends are not considered to be income tax purposes since they are return of unused premiums. Social Security was created to provide all of the following benefits except unemployment income. Social Security is designed to provide protection against financial loss due to old age, disability, or death. It also provides income during retirement. Which of the following is eligibility required for all Social Security disability income benefits? Have attained fully insured status. Although Social Security offers many benefits, just as retirement, survivors, and Medicare, only those who have attained fully insured status are eligible for disability income benefits. Contributing to Social Security for 40 quarters, 10 years, attains fully insured status. Which of the following is true regarding taxation of dividends in participating policies? Dividends are taxable in some life insurance policies or not. Dividends are considered income for tax purposes. Dividends are not taxable. Dividends are taxable only after a certain amount is accumulated. Dividends are not taxable. Dividends are not considered to be income for tax purposes since they are a return of unused premiums. The interest earned on the dividends, however, subject to taxation as ordinary income. Who is the third party owner? The third party owner is the legal term used to identify an individual or entity that is not on the insurance under the contract but that has a legally enforceable right under it. Which of the official name of the Social Security program? Old Age Survivor Disability Insurance. Social Security is formerly called Old Age Survivor Disability Insurance, OASDI. Two attorneys operate their practice as a partnership. They want to start a program through their practice that will provide retirement benefits for themselves and three employees. They would likely choose the HR10 KOGH plan, are plans specifically for self-employed and their employees. All of the following statements are true regarding tax qualified annuities except except employers' contributions are not tax deductible. Tax qualified annuities must be reported by the IRS and allows for tax deductible employer contributions. All withdrawals are taxed and earnings are grow tax deferred. All of the following employees may use 403b plan for their retirement except the CEO of a private corporation. Not all public employees are eligible for 403b plans or tax shield annuities. Only employees of public education, local, state, or federal, as well as employees of charitable organization. Which of the following is an example of liquidity in a life insurance contract? The cash value available to the policy owner. Liquidity is in life insurance refers to availability of cash to the insured. Some life insurance policies offer cash value that can be borrowed at any time and used for immediate needs. Which of the following describes the tax advantage of a qualified retirement plan? The earnings in the plan accumulated tax deferred. Contributions are tax deferred, and earnings on the money in the plan accrue on a tax deferred basis. Uninsureds under life insurance policy have been diagnosed with terminal illness and had 6 months to live. The insured knows that his financial state will worsen even more with the upcoming medical expense. What option could be insured utilize? Viatical settlement. A viatical settlement allows an insured with life-threatening condition to sell the existing policy in order to receive benefits when they are most needed. Viators typically receive a percentage of the policy's face value from the person who purchased the policy. Which of the following would describe the legal document which would dictate who can buy the deceased partner's shares of business or for what amount? Buy-sell agreement. A buy-sell agreement, also referred to as a business continuation agreement, is a legal contract that determines what will be done with a business in the event of the owner dies or becomes disabled. A producer is helping a married couple determine the financial needs of their children in the event of one or both should die prematurely. This is a personal use of life insurance known as survivor protection. Life insurance can provide the funds necessary for the survivor of the insured to be able to maintain their lifestyle in the event of insured's death. This is known as survivor protection. Which of the following is true regarding taxation of accelerated benefits under the life insurance policy? They are tax-free to terminally ill insured. When accelerated benefits are paid under the life insurance policy, they are received tax-free by terminally ill insured and tax-free up to a limit for chronically ill insured. In a life settlement contract, whom does the life settlement broker represent? The owner. Life settlement broker is a person who, for compensation, solicits negotiation on offers to negotiate a life settlement contract. Life settlement brokers represent only the policy owners. What is the primary purpose of 401k plan? Retirement. Profit sharing plans are qualified plans where a portion of a company's policy is contributed to the plan and shared with employees. A 401k qualified retirement plan allows employees to take reduction in their current salaries by deferring amounts into a retirement plan. The company can also somehow match the employee's contribution, whether it is dollar for dollar or on a percentage basis. Which of the following is concerning a non-contributory group plan? The employee receives individual policies. The employee receives a master policy. The employee receives a certificate of insurance. Which of the following employees are insured under group life policy would be allowed to convert to individual insurance of the same coverage once the plan is terminated? The one who has been insured under the plan for about at least 5 years. In life insurance policy, cash value increases. Growth tax deferred. Generally, life insurance cash values are only income tax if the policy is surrendered totally or partially and the cash value exceeds the premiums paid. An employee has a group life insurance through her employer. After 5 years, she decided to leave the company and work independently. How can she obtain an individual policy? She can convert her group policy to individual policy without a group of insured within 31 days of leaving the group plan. Which of the following is an eligibility requirement for all Social Security disability income benefits? Have attained a fully insured status. All the Social Security offers many benefits, retirement survivors and Medicare. Only those who have attained fully insured status are eligible for disability income benefits. Contributing to Social Security for 40 quarters, 10 years attained fully insured. All of the following are business uses of life insurance, except funding against companies' general financial loss. Both life and health insurance can be used for a variety of purposes in business settings, including the funding of business continuation agreements, compensating executives, and protecting the firm against financial loss resulting from the death of a disability of a key employee. In the life insurance policy, develops cash value faster than a 7-pay all life contract. It becomes a modified endowment contract. Any cash value that covers cash value faster than the 7-pay whole life contract is called a modified endowment contract and loses the benefit of a standard life contract. All of the following are examples of third-party ownership of a life insurance policy except insured borrows money from the bank and makes a collateral assignment of a part of the debt benefit to a secure loan. A collateral assignment is the transfer of some of all the debt benefit of the policy to a creditor as a security for a loan, but does not give the creditor the rights of ownership. In the event of the insured's debts, the creditor must would only be able to recover that portion of the policy proceed equal to the creditor's remaining interest in the loan. Which of the following best defines the owner as it pertains to the life settlement contracts? The policy owner of the life insurance policy, the term owner, or refers to the owner of the policy who may seek to enter into a life settlement contract. The term does not include any insurance provider, a qualified institutional buyer, a financial entity, and specially purpose entity related to provider trust. Death benefits payable to a beneficiary under the life insurance policy are generally not subject to income taxation by the federal government. When premiums are paid with after-tax dollars, the death benefit is generally not subject to federal income taxation. Which of the following statement about group life is correct? The cost of coverage is based on the ratio of men and women in the group. Group life insurance can be converted to an individual whole life, not a term policy. The group life insurance premiums are usually lower than those of the individual policy. The group sponsors receive some master contract while the participants receive certificate of insurance. The cost of the coverage is based on the average of group and the ratio of men to women. What percentage of companies' employees must take part in a non-contributory group life plan? 100%. If the employee if the employer pays all of the premium, all employees must be covered to avoid adverse selection. Which of the following is not true regarding policy loans? Money borrowed from the cash value is taxable. The minimum number of credits required for partially insured status of Social Security disability benefits is to be considered partially insured. An individual must have 6 credits during the last 13-quarter period. All of the following are characteristic of group life insurance plan except there is a requirement to prove insurability on the part of the participant. There is no individual underwriting for group life insurance. An employee quits his job and converts his group life policy to an individual policy. The premium of the individual policy will be based on his attained age. If an employee terminates membership in the insured group, the employer has the right to convert to an individual whole life policy without proving insurability. The insurer will determine the type of policy an employee or may convert to, but it must be issued at a standard rate based on the individual's attained age. Group life insurance is a single policy written to provide coverage to a member of group which is the following statement concerning about group life is correct. 100% participation of members is required in non-contributory plans. If the employer pays all of the premium, then all of the employees must be included. What is the name of the insured who enters into a viatical settlement? Viator. Viator means the owners of the life insurance plan who enters into seeks to enter into a viatical settlement contract. The premiums paid by the employer in a business life insurance policy are tax deductible by the employer. The premiums that our employer pays for the life insurance of an employee, whereby the policies for the employee's benefits are tax deductible to the employer as a business expense. To attain current insured status under Social Security, a worker must have earned at least how many credits during the last 3 quarters? 6 credits to be considered currently partially insured. All of the following are characteristic of a group life insurance except amount. Premiums are determined by age, sex, and occupation of each individual certificate holder. An employee quits his job on May 15 and he doesn't convert his group life policy to an individual policy for 2 weeks. He dies in a freak accident on June 1st. Which of the following statement best describe what will happen? insurer will pay the full death benefit from the group policy for the beneficiary. The employee usually has a period of 31 days after terminating from the group in order to exercise the conversion option. During this time, the employee is still covered under the original group policy. Death benefits payable to beneficiary under the life insurance policy are general, not subject to income taxation by the federal government. In which of the following insurance would be tax deductible? Premiums paid by employer on a 30,000 group term life insurance plan for employees. Which of the following is true regarding taxation or of auxiliary benefits under the life insurance policy? Tax paid to terminally ill insured. 40. The term fully insured refers to someone who has earned 40 quarters of coverage, 10 years of work times 4 maximum annual credits. Quarters. Which of the following insurance arrangement will be appropriate for a parent buying a life insurance policy on a child where the parent is the policy holder? An employee quits his job and converts a group life policy to an individual policy. The premium for the individual policy will be based on his term is membership. Life policy with the insurer will determine what type of policy covered, but it must be issued at the standard rate based on the individual's sustained age. A 60-year-old participant in 401k takes a distribution rolls over to Naira within 60 days, which the following is true. Distribution is reduced. The amount of distributions is reduced by the amount of 20% withholding tax. All are the following true. A distribution, all amounts received by the employee are tax-free. Funds in a qualified plan accumulated on tax-deferred basis. However, at distribution, any amount received by the employee will be treated as ordinary income or tax purposes. All of the following are examples of third-party ownership of a life insurance policy, except What does liquidity refer to in a life insurance policy? Executive bonus plan, who is the owner of the policy and will pays the premium. With the key person covers the employer is the applicant, owner, premium payer, and the beneficiary. All of the following are personally uses of life insurance except buy-sell agreement. Personal use of life insurance includes survivor protection, estate creation, and cash evacuation, and liquidity. Buy-sell agreements is for business use of life insurance. In order to qualify conversion from group life policy that has been terminated to an individual policy of the same coverage, a person must have been insured under the group plan for how many years? If the master contract is terminated, every individual who has been on the plan at least 5 years will be allowed to convert. All of the following statements concerning an employee's qualified retirement plan are true except the employer can receive a current tax deduction for any contribution made to the plan Employers do not receive a current tax deduction for any contribution made to the co-op or to a non-qualified plan. The plans are legal, however, they do not qualify for any favorable tax treatment under the IRS rules. Who may contribute to HR plan? Self-employed plumber. Self-employed person may contribute to the HR. An individual has been diagnosed with Alzheimer's. He is insured under the life insurance policy with accelerated benefits rider. Which of the following is true regarding taxation of accelerated benefits? A portion of the benefits up to a limit is tax-free. The rest is taxable income. When accelerated benefits are paid to a chronically ill insured, they are tax-free up to a certain limit. Any amount receiving in excess of the dollar limit must be included in the insured's gross income. The advantage of a qualified plan to employee is employers. Tax deductible contributions. What is the person who company's employees must be part of the non-contributive life plan? Employer pays all the premium. All employees must be covered by adverse selection. 60%. Quiz. Which of the following is not true regarding non-qualified retirement? It needs IRS approval. Which of the following is not true regarding non-qualified retirement plan? It needs IRS approval. An Internal Revenue Code provision that specially provides for an individual retirement plan for a public school teacher is an 403 plan, STSA. An insured has a modified endowment contract. He wants to withdraw some money in order to pay medical bills. Which of the following is true? He cannot withdraw money from his MEC before age 59 and a half. He will pay a penalty if he is younger than 59. He will have to pay penalty regardless of his age. He will not have to pay a penalty regardless of his. Which of the main purposes of 7-pay test? It determines if the insurance policy MEC. An individual has been diagnosed with he is insured under the life insurance policy with accelerated benefits. Which of the following is true regarding taxation of accelerated benefits? Apply by the certificate of insurance given to which of the following statements is true regarding concerning whole life insurance? If 100,000 life insurance were used in a settlement option which paid 30,000 per year for 10 years, which of the following would be taxable income? Taxable annually. What about your business use of life insurance? The president of the manufacturing company has over the plan would be funded with before tax corporation. It does not. It's a non-qualified annuity plan. A non-qualified plans are perfectly legal way for selected employees to receive certain types of benefits. Before tax, corporate dollars can be used for these plans, and they are not subject for government standards. Because of this, however, non-qualified plans contributors contributions are not tax deductible, unlike with qualified plans. Who may contribute at least self-employed plumbers? Which of the following terms means the result of a calculation based on the average number of months the insured is projected to live due to medical history and mortality factors? Tama ako. Life expectancy is an important concept in life settlement contracts. It refers to the calculation based on the average number of months the insured is projected to live due to the medical history and mortality factors. An arithmetic mean. An employee is joining a group insurance plan in order to avoid having to prove insurability. What must the employee do? Join during the employment, provide medical care, sign a settlement, continue good. Nothing. Prove insurability is never required in group policies. Oh shoot! I pass.